Welcome to The Explainer. Today, we're diving into a really big question, one that gets to the very heart of how the business world works. And we're not going to rely on opinions. Nope. We're digging into the hard data from an amazing study to find out what's really going on.
So let's get right to it. We all know that lying is a bad look. But what happens when a giant company gets caught cooking the books on purpose? What's the actual tangible cost of that lie? Is it just a fine, a slap on the wrist, and then business as usual? Or is the damage something much deeper, something that money can't easily fix?
You know, the study uses this perfect analogy to help us get our heads around it. For us, a good credit score means a bank will give us a loan at a decent rate. Well, for a company, its reputation is basically its credit score. It's a signal to the world, especially to lenders, that says, hey, you can trust our numbers. We're good for it. A solid reputation means cheaper access to money. Simple as that. Now, let's be super clear about what we're talking about here. This isn't about an honest accounting mistake or a typo in a spreadsheet. The researchers zeroed in on deliberate acts, what the industry calls irregularities or, just plain fraud. This is when a company knowingly lies about its financial health. Okay, so the lie is out. The scandal hits the news. What's the first thing that happens? Let's look at the immediate financial blowback, the punishment the market hands out right away.
So how do you even measure something like that? Well, the researchers' method was actually pretty brilliant and direct. They looked at the interest rates banks charged these specific companies for loans before anyone knew about the lie, and then they compared those to the rates they got charged after they were caught. It's the perfect before and after picture of how lenders see them. And wow, the impact was immediate, and it was harsh. Before the scandal, these companies were paying on average about 153 basis points for a loan. After the news broke, that number shot up to 238 basis points. We're not talking about a small bump here. The cost of doing business basically exploded for them overnight.
Okay, but I know what you might be thinking. Hang on, maybe other things were going on. Maybe those companies just got riskier in general. And that's a totally fair point. So to really isolate the penalty for just the lie, the researchers did something else that was really smart. They compared the guilty companies to a control group of very similar but totally honest companies. And when they crunched those numbers, the result is just staggering. In the very first year after getting caught, the lying companies paid a whopping 45% more for bank loans than their honest counterparts. That right there, that is what the study calls the misreporting penalty. It's basically a 45% tax for breaking trust.
So a 45% penalty is, absolutely brutal. But surely that fades over time, right? People forget, the market moves on. You'd think that after a year, maybe two, things would start to level out and get back to normal.
But this is where the story takes a truly shocking turn. The data shows the exact opposite happens. Look at this. Year 1, the penalty is 45%. Year 2, it actually goes up to 55%. 5 years later, it's still over 50%. And then, get this, in years 6 through 8, it balloons to an unbelievable 86% premium. Let that sink in for a minute. Time doesn't just fail to heal this wound, it seems to make it worse. The penalty for that original lie doesn't fade away. It lingers for years and years, like a ghost in the company's financials. The market, it turns out, has a very, very long memory. So, imagine you're a top executive at one of these companies. The building is on fire, financially speaking. You are bleeding cash on these insane interest payments. You've got to do something, anything, to show the world you've changed your ways. Which brings us to the next part of this saga, the cleanup operation. And they definitely try. They do all the things you'd expect. They fire the CEO, they fire the CFO, they bring in new independent people for the board, they get a whole new auditing firm. They're basically screaming from the rooftops, "Look, we're different now. We've cleaned house. Please, please, trust us again." And you can see just how hard they're trying in the data. The study shows these scandal-plagued companies are way more likely to take these dramatic steps than their honest competitors. They are working overtime, throwing everything they have at trying to fix their broken reputation. Which all leads to the one big, multi-billion-dollar question. After all that effort, firing the top brass, hiring new auditors, restructuring the entire company, did any of it actually work? Did they manage to convince the banks to forgive them and, lower that crushing financial penalty? So now we come to the final verdict, the judgment handed down by the very group these companies were trying so desperately to win back, the banks.
And the answer, in one short, brutal word, was no. And the numbers behind that no are just jaw-dropping. The researchers checked to see if maybe doing more repair work helped. But look at this. Whether a company took just one corrective action or went all out and took 3 or more, it made no difference. Years later, the penalty was still a staggering 88 to 89%. I mean, the takeaway here is just crystal clear. All of that frantic scrambling, all that money spent on rebuilding their image, it had basically zero effect on the punishment. Once that trust was fundamentally shattered, the market simply refused to give it back. Its memory isn't just long, it's completely unforgiving. You know, the researchers who did this work summed it up perfectly. They basically said that companies would be so much better off just putting all their effort into not lying in the first place, rather than thinking they can somehow fix the damage later. Because as the evidence shows, they can't. And really, that's the thought I want to leave you with. Think about it. Banks are the ultimate financial insiders. They have more data and more analysts than anyone. And if they look at all this and conclude that the damage from a lie is basically permanent, what does that tell you about the real nature of trust? It tells you that in the cold, hard world of finance, trust isn't some soft, fuzzy feeling. It's a hard asset. And it just might be the one asset that, once you break it, you can never, ever get back.